As you know, we always run through this. It's our strategy, simple three-step strategy. I think it's important that we do. I'm sure you're all familiar with it, but it's just a question of, are we sticking to what we said we're going to do, or is there style drift going on? So only invest in good companies, the first point. Second point is don't overpay. Third is do nothing. Let's start with only invest in good companies. This is our look-through table, which we publish every year. We take the companies in our portfolio, we work out a number of measures and ratios for them, and we show them these metrics to you, weighted for the holdings in our portfolio, so you can gauge from these metrics whether you think we've got good companies or not. Last year, the return on capital employed in our portfolio is 32%, which might be an all-time record, I think. So quite clearly, it improved significantly from the trough, which it reached of 25% during the pandemic, and it's getting on for 2 times the level of the index. If you look over to the right, where we've got the S&P and the FTSE 100, in our view, the single most important measure of whether or not we really want to own a business is what kind of return on capital it can deliver. Gross margins were rock steady at 64%. Our companies are making things for 36 and selling them for 100. As you look over to the indices, you'll see they're pretty rock steady as well, in the sort of low 40s. They're making things for 60 and selling them for 100. It's clearly better to make things for 40 something and sell them for 100, or 36 and sell them for 100, than it is to make things for 60 and sell them for 100. And this is the biggest single fundamental defense there is against inflation, basically, which is to say it tells you what the input cost inflation will do to your margins, and also gives you a clue how much you may have to adjust prices to try and keep up with inflation. Operating profit margins, taking out the remainder of operating expenses, selling, general and administrative expenses, you'll see rose to 28% last year, which again is sort of a record high for the companies, and significantly higher than either the S&P or the FTSE 100. Cash conversion is a bit peculiar. It's dropped to 88% and is about the same as the S&P, although still well ahead of the FTSE. We like cash measures. We like measuring cash conversion. We like measuring free cash flow generation. We like measuring free cash flow yield. We like cash because it's a very acid test, but it's also a very volatile measure, and you need to probably take multi-years sometimes into account. The whole point about accrual accounting, where we look at profits rather than cash, is that the accrual accounting methodology is to spread cash flows, ins and outflows, across a number of reporting periods for some items. And so what you're seeing at work here are some peculiar factors around the events of the pandemic and the unwinding of the pandemic. During the pandemic, quite a number of companies that we invest in had stock outs. They basically sold the whole of their stock. They couldn't make enough to keep up with demand in a number of cases. In some cases, they had problems with inputs. They were selling out stock pretty rapidly, but they couldn't get replacement componentry, particularly in things like semiconductors, although there were plenty of more mundane things like bleach, where capacity just wasn't sufficient. The net result of that is, when they've had the opportunity to stock up on the components like semiconductors as they became available, they basically binged on those. They've gone from just-in-time methodology of keeping things like components to just in case. They don't want to be caught out again by running out of components and items like that. So it's depressed cash conversion. I think we really probably need to take a multi-year view here in order to get a clear picture. So I think it will be at least another 12 months before we can sit back and say, yeah, we're back to about 100% conversion. But I think we'll get there. Interest cover was 20 times on our companies last year. So their interests and rents were covered 20 times by their operating profits. That's about twice the index. So they're good operating performances and not being generated by lots of financial engineering. These are very conservatively financed companies. And looking at that financial metric picture, I would say to you, it's pretty clear, notwithstanding a couple of individual stock problems, which I've been quite open about in relation to the portfolio. There's always a problem of some sort. In market conditions like this, I think they're going to be exposed. Taken as a group, I think we own companies which are very good companies and which are very significantly better than the index.